Disclaimer.
AG here, and I've got the kind of news that makes financial advisors nervous and gold dealers very happy. While 116 people lie dead in Iran and Trump reviews military strike options, 2 million barrels of daily oil exports just became the world's most expensive question mark. Let's talk about what happens to your money when the Middle East's fourth largest oil producer goes dark. On January 9th, a Nobel Peace Prize laureate issued a warning that should have made global headlines. She described what was about to unfold in Iran as a planned massacre under a communications blackout. 3 days later, at least 116 people are confirmed dead, though eyewitness reports from a single Tehran hospital describe over 200 bodies in morgue hallways. Iran's internet has been 99% offline since January 8th, creating the kind of information vacuum that typically precedes something the world isn't supposed to see clearly. Here's what should grab our attention as Americans watching our investments and energy costs. While Tehran goes dark and protesters fill the streets, 2 million barrels of oil per day hang in the balance. That's Iran's daily export number, generating $126 million every single day at current Brent crude prices of $63 per barrel. We're talking about OPEC's fourth largest producer. And right now, President Trump has military strike options sitting on his desk, while Iranian officials declare that all U.S. bases are legitimate targets. Think about the timing of what you're witnessing. Gold just hit $4,890 per ounce, marking a staggering 71% increase year over year. Silver reached record highs of $250 per kilogram. Oil jumped 5% in just 2 trading sessions on fears of supply disruption. Markets are pricing in something most news coverage isn't fully explaining, and that something involves the mathematical reality of what happens when 2 million barrels per day suddenly become uncertain. Let me paint you a picture of what's actually unfolding on the ground in Tehran right now. The Grand Bazaar, a sprawling marketplace that has stood as the economic heart of Iran for centuries, has shut down completely. This isn't just any commercial district. The bazaar merchants have been a pillar of regime support since the 1979 revolution, the kind of business class that keeps authoritarian governments financially stable. When they close their shops and walk away, something fundamental has shifted. Meanwhile, in Mashhad, Iran's second largest city and home to the country's holiest shrine, protesters are chanting "Death to Khamenei" inside their religious complex itself. We're witnessing dissent in locations that were previously untouchable, sacred spaces where criticism of the supreme leader would have been unthinkable just months ago. According to reports compiled by human rights organizations, authorities have arrested over 10,600 people and are threatening enemy of God charges that carry the death penalty. This represents the largest challenge to the Islamic Republic since its founding. Now here's where the financial implications become impossible to ignore. You need to understand who's been buying Iran's oil and what's changed in the equation. China has been purchasing roughly 90% of Iran's crude exports, approximately 1.38 million barrels per day, and they've been getting it at a discount of $7 to $8 below benchmark prices. That's a sweetheart deal that's been funding the Iranian government while giving Chinese refiners cheap feedstock for their massive industrial machine. But something happened recently that's disrupting this entire arrangement. Venezuela fell in just 6 days. When the Maduro regime collapsed and the new government came in, Trump's administration immediately announced criminal penalties for any company doing business with sanctioned oil. Chinese refiners, who had been happily processing both Venezuelan and Iranian crude under the radar, suddenly found themselves facing real consequences in the form of potential access cuts to U.S. financial systems. Pop quiz? What happens when the world's largest oil importer gets spooked about buying discounted crude from a country whose government might not exist in 3 weeks? The answer is sitting in Iran's rapidly depleting foreign exchange reserves, and in the premium you're about to see in oil prices. According to the Iranian government's own statements, they're generating about $7 billion per month from oil sales, the vast majority going to China. Now imagine that revenue stream getting cut off, not because of Western sanctions, but because Chinese companies decide the Trump administration's threats are credible enough to make Iranian oil toxic. We've already seen Chinese independent refiners dramatically reduce their Iranian crude purchases in recent weeks, and that was before Tehran went dark and protesters started burning government buildings. Let me connect this directly to your portfolio and your daily life. When Iran's oil exports get disrupted, whether through political collapse, military strikes, or Chinese refiners backing away, markets don't wait for official confirmation to reprice energy. Oil traders look at 2 million barrels per day potentially coming off the market, and they start bidding up futures contracts immediately. Energy analysts are estimating a 15% to 25% price jump if Middle East supply shocks materialize, which would push oil from its current $63 per barrel to somewhere between $75 and $85. Have you noticed what's been happening in precious metals markets while this crisis builds? The moves aren't subtle. Gold's 71% year-over-year gain represents the kind of safe haven demand we typically see when investors believe geopolitical stability is deteriorating rapidly. Silver's record highs are even more telling because silver serves both as a monetary metal and an industrial commodity. When both functions are driving prices higher simultaneously, it signals that markets are pricing in both economic uncertainty and potential supply chain disruptions. According to data from COMEX, silver inventories have dropped 70% since 2020. The London Bullion Market Association reports that gold inventories are down 40% over the same period. Meanwhile, China's central bank just completed its 14th consecutive month of gold purchases, accumulating reserves while its refiners nervously eye their Iranian oil contracts. Bank of America recently published research targeting silver prices between $135 and $309 per ounce, ranges that seemed outlandish 6 months ago, but look increasingly plausible as physical shortages accelerate. Here's the pattern you need to recognize. Venezuela's government fell in 6 days. Cuba got cut off from its primary support within 48 hours. Iran has now been under communications blackout for 60 hours, while bodies pile up in Tehran hospitals and the country's traditional power brokers shut down their businesses in protest. These aren't isolated incidents. They're dominoes falling in sequence, and each one removes a piece of the global oil supply puzzle that's been holding energy prices artificially low. Think about what this means for your investments, your retirement accounts, your ability to plan for major purchases. If you're holding stocks in energy companies, you're about to see earnings projections revised upward as oil prices climb. If you own bonds, you're facing the prospect of inflation pressures from higher energy costs eroding your real returns. If you're sitting in cash, you're watching purchasing power decline as the dollar potentially weakens against commodities. The mathematical reality is straightforward and unforgiving. Global oil demand runs about 102 million barrels per day. Iran supplies 2% of that total. When 2% of global supply becomes uncertain, prices don't move by 2%. They move by multiples of that percentage because traders, refiners, airlines, and every other entity that depends on predictable energy costs starts competing for available barrels. The market doesn't care about your gas budget or your company's transportation costs. It prices in scarcity the moment scarcity becomes probable. According to the World Gold Council, central banks purchased over 1,000 tons of gold last year, the second highest annual total on record. The Bank for International Settlements reports that gold's role in international reserves has been expanding as countries diversify away from dollar-denominated assets. What you're watching in Iran right now is exactly the kind of geopolitical instability that makes central bankers nervous enough to convert digital currency reserves into physical metal. Here's what most coverage is missing. This isn't just about Iran's internal politics or even about Trump's military options. It's about the moment when markets realize that the oil supply cushion everyone's been assuming exists might not actually be there when it's needed. When Venezuela's production went offline, markets shrugged because other producers could make up the difference. When Iranian supplies become questionable while Trump threatens additional sanctions on any country buying Russian oil, the mathematical buffer disappears. You're watching the setup for a supply shock that could reshape energy markets for months or years. The question isn't whether Iran's situation will impact oil prices. The question is whether you're positioned for what comes next, when 2 million barrels per day become the subject of military planning and geopolitical brinkmanship rather than routine commercial transactions. Let me show you the documented evidence that makes this different from every other Middle East crisis you've lived through. We're watching actual collapse indicators historians will point to when they write about how quickly things unraveled. Start with Tehran's Grand Bazaar. This isn't a shopping mall that closed for a holiday weekend. The bazaar has operated continuously through wars, sanctions, and revolutions for literally centuries. These merchants represent old money, establishment families, the business elite that funded the 1979 revolution and kept the Islamic Republic financially viable through decades of isolation. According to reports from Iranian journalists still getting information out through satellite connections, entire sections employing thousands of people are completely shuttered. These business owners aren't protesting for democracy. They're cutting their losses because they've calculated the regime's shelf life has expired. Now travel east to Mashhad, home to Iran's holiest shrine. Imagine protesters chanting against the Pope inside St. Peter's Basilica. That is the level of sacred boundary being crossed when Iranians stand in Mashhad's shrine of Imam Reza and chant death to Khamenei, directing fury at the supreme leader himself. The government's response tells you everything about their panic. Over 10,600 arrests in just days. According to human rights organizations, authorities are charging protesters with moharibeh, enmity against God, a capital offense carrying the death penalty. When a government threatens to execute thousands of citizens for protesting, traditional crowd control has already failed. What's unfolding now combines elements of previous Iranian protests, while adding something new. The traditional pillars of regime support are visibly crumbling. But here's what's accelerating the timeline. You already know China buys 90% of Iran's oil exports, roughly 1.38 million barrels per day. Chinese refiners were getting a steep discount of $7 to $8 per barrel below benchmark prices, saving roughly $3.5 to $4 billion annually. When Venezuela fell and Trump's administration announced criminal penalties for companies doing business with sanctioned regimes, Chinese refiners had to make a cold calculation. According to shipping data from maritime tracking services, Chinese independent refiners have cut their Iranian crude imports by approximately 30% over the past month. That's 400,000 barrels per day, suddenly not generating revenue for Tehran. Think about what that means. Iran generates about $7 billion per month from oil sales. A 30% reduction in Chinese purchases means they're losing more than $2 billion monthly. And that was before the protests intensified, before the internet went dark, before the Grand Bazaar shut down. When Maduro fell in 6 days, companies with Venezuelan exposure got burned immediately. Nobody wants to be caught holding Iranian contracts when similar consequences arrive. The problem for Iran is mathematical and unavoidable. You can't simply find replacement buyers overnight for 2 million barrels per day when you're under international sanctions and facing potential regime collapse. Now let me show you what's happening in precious metals markets, because this is where smart money is showing you what they expect next. COMEX silver inventories have dropped 70% since 2020. 7 out of every 10 ounces sitting in registered warehouses have been withdrawn. The London Bullion Market Association reports similar drawdowns in gold, with inventories down 40%. These are the kind of inventory movements that happen when large institutions convert paper claims into physical metal. According to the World Gold Council's quarterly reports, the central banks have been net buyers of gold for 14 consecutive months. China's central bank has added to reserves every single month while reducing U.S. Treasury holdings. When central banks make these sustained allocation shifts, they're repositioning for scenarios where physical assets become more valuable than financial assets. Bank of America's commodities research recently published targets for silver ranging from $135 to $309 per ounce. Silver at 135s would represent more than a 50% gain from current record levels. Silver at 309 would be a complete revaluation of the metal's monetary role. What makes those targets credible is supply-demand fundamentals combined with historical precedent. According to the Silver Institute, industrial demand has been exceeding mining supply by significant margins. Solar panels, electronics, medical equipment, and electric vehicles all require silver with no substitutes. At the same time, investment demand surges as both retail and institutions seek inflation protection and geopolitical insurance. Have you looked at what happened to gold and silver during previous oil crisis periods? In 1979, when Iran's revolution disrupted oil markets, gold went from $226 to $850 in 5 months, a 276% move. Silver went from $6 to $50, an even more dramatic 733% gain. History doesn't repeat exactly, but the pattern shows precious metals respond violently to Middle East supply disruptions. Let me connect these market indicators to what's happening on the ground. The regime is burning through foreign exchange reserves trying to defend the rial and maintain imports. According to estimates from economists tracking Iran's external accounts, they're spending between $500 million and $1 billion monthly just defending their currency. When you combine that defensive spending with the $2+ billion monthly loss in oil revenue, you get a government mathematically running out of time before it can't pay its security forces. Venezuela's Maduro regime had oil revenues right until the moment the military decided those revenues weren't worth defending a collapsing government. When security forces stopped getting paid reliably, the government fell in less than a week. According to reporting from journalists with sources inside Iran's security apparatus, mid-level Revolutionary Guard commanders are questioning orders to fire on protesters. When that hesitation appears in regime security forces, history suggests you're in the final phases of collapse. The Shah's military ultimately refused to keep shooting Iranian citizens in 1979, and that refusal ended his reign. Here's the hard truth markets are pricing in. Iran's government has maybe 2 to 3 weeks before either a complete crackdown that kills thousands or a terminal loss of control that ends the Islamic Republic. Either scenario creates massive oil supply uncertainty. Either scenario drives precious metals higher as safe haven demand intensifies. Either scenario changes the Middle East power balance in ways that will impact American foreign policy and energy security for years. You're watching the proof unfold in real time. Tehran's business elite have abandoned the regime. Religious protesters openly defy authority in sacred spaces. China's refiners quietly back away from oil purchase commitments. Physical gold and silver inventories are being drawn down by buyers expecting financial system stress. The mathematical inevitability of what comes next becomes clearer every day the internet stays dark in Tehran. Now let us run the numbers on what happens to your portfolio when Iran's 2 million barrels per day become the center of a geopolitical crisis. These aren't predictions or speculation. These are mathematical calculations based on how energy markets have responded to Middle East supply disruptions throughout history. If Iran's oil exports get disrupted, whether through regime collapse, military strikes, or continued Chinese refiner pullback, analysts are projecting oil prices jumping 15% to 25% from current levels. That puts crude oil somewhere between $75 and $85 per barrel. Think about what that means for your daily life. Gas prices climbing 20% to 30% within weeks. Airline ticket costs rising as jet fuel expenses spike. Shipping costs for everything from Amazon packages to grocery store deliveries increasing across the board. Inflation pressures that the Federal Reserve thought it had contained suddenly roaring back. But here's where it gets interesting for those paying attention to safe haven assets. According to research from JP Morgan and Bank of America, gold is targeting $5,000 per ounce by the end of January. We're currently at $4,590, so we're talking about a potential 9% move in the next 2 weeks. That might not sound dramatic until you realize that represents roughly $400 per ounce gains while geopolitical uncertainty peaks. Silver's math is even more compelling. If we see the kind of safe haven flows that typically accompany Middle East oil shocks, silver could potentially double from current record levels to $160 or higher within 60 days. You need to understand why silver moves more violently than gold during these periods. Gold is purely a monetary metal and store of value. Silver serves double duty as both money and industrial commodity. When investors panic into precious metals for safety while simultaneously worrying about supply chain disruptions affecting electronics, solar panels, and electric vehicles, you get buying pressure from both directions. The Silver Institute, this supply-demand data shows we're already running structural deficits before any crisis premium gets added to prices. Now let me tell you about something happening this week that almost nobody's connecting to the Iran situation. Wednesday, January 14th, the Supreme Court is ruling on Trump's tariff implementation. If the court strikes down the tariffs, that potentially injects $140 billion in liquidity back into markets as trade flows normalize. If they uphold the tariffs, the dollar strengthens against other currencies as American manufacturing gets protected. Either outcome creates a binary moment for precious metals positioning, and it's happening right as Iran's crisis reaches critical mass. Think about the timing convergence we're witnessing. Iran's internet has been dark for over 60 hours. The Supreme Court rules in less than 48 hours. Trump has military strike options on his desk. Chinese refiners are backing away from Iranian oil contracts. Central banks continue their 14th consecutive month of gold accumulation. These aren't isolated events. They're dominoes positioned to fall in sequence. And the sequence has already started. Let me paint you a scenario based on recent historical precedent. Venezuela's government fell in 6 days from the moment protests reached critical mass. Cuba got cut off from its primary support within 48 hours of Venezuela's collapse. Iran's current 60-hour communications blackout eerily mirrors what happened in November 2019 when the regime shut down the internet and proceeded to kill an estimated 1,500 protesters over the following days. That crackdown bought them years of stability, but it also showed the world exactly how fragile their control had become. Here's the calculation you need to make as an American watching your savings and investments. If Iran's regime collapses in the next 2 to 3 weeks, oil markets will price in the loss of 2 million barrels per day before we know who controls Iran's oil fields or whether production continues. If the regime launches a massive crackdown similar to 2019, oil markets will price in the probability of Western military intervention and retaliatory Iranian actions against shipping in the Strait of Hormuz. Either scenario drives oil above $75 and potentially toward $100 if the crisis escalates beyond Iran's borders. According to energy market analysts who've modeled Middle East supply shock scenarios, every million barrels per day that comes off the market typically drives oil prices up by 10% to 15% in the initial panic phase. Iran's 2 million barrels represent a 2% hit to global supply, but markets don't move linearly. They overshoot during uncertainty. The 1979 Iranian Revolution took less than 6% of global oil supply offline and drove prices up over 150% within a year. We're not predicting that exact scenario, but the pattern shows oil markets react violently to Iranian instability. Have you thought about how this connects to your retirement accounts? If you're holding typical index funds heavily weighted toward technology and growth stocks, you're exposed to companies that get hammered by rising energy costs. Their profit margins compress as transportation and operational expenses climb. If you're in bonds, you're facing renewed inflation concerns that erode your real returns. If you're sitting in cash, you're watching purchasing power decline as commodity prices surge. Pop quiz. What asset class historically outperforms during periods when oil shocks meet geopolitical crisis? precious metals, particularly silver, when industrial demand stays strong despite economic uncertainty. Bank of America's research targeting $135 to $309 silver isn't based on fantasy. It's based on supply-demand math combined with safe haven flows during periods when traditional financial assets become unreliable. Let me give you specific positioning guidance based on what markets are telling us right now. According to the World Gold Council, central banks aren't slowing their gold purchases despite prices at record highs. That tells you institutional money believes gold is going higher regardless of current valuations. The 70% drawdown in COMEX silver inventories tells you physical metal is becoming increasingly difficult to source at current prices. When inventory gets tight and demand surges, prices don't adjust gradually. They gap higher violently. Here's what Wednesday's Supreme Court ruling means for your decision timeline. If tariffs get struck down and $140 billion in liquidity floods back into markets, some of that money will chase precious metals as an inflation hedge. If tariffs get upheld and the dollar strengthens, it creates a temporary pullback opportunity in gold and silver prices before geopolitical concerns override currency strength. Either way, the Iran crisis isn't waiting for Supreme Court decisions. It's unfolding on its own timeline, and that timeline suggests major developments within the next 2 to 3 weeks. Think about what positioning before markets fully price in a 100-plus oil scenario means for your portfolio. Energy stocks become obvious beneficiaries, but they also carry political risk if governments impose windfall taxes or price controls. Precious metals offer pure play exposure to crisis premium without the political risk. Physical metal gives you an asset that does not depend on any government solvency or any company's continued operations. According to traders watching options markets, implied volatility for oil futures has spiked significantly over the past week. That means big money is hedging for major price swings. Gold and silver options show similar volatility expansion. When professional traders start buying protection against extreme moves, retail investors should pay attention. These aren't perma-bears or conspiracy theorists. These are institutions with billions at stake making calculated decisions about probable outcomes. Here's the reality we're facing as Americans. Our economy runs on predictable energy costs. Our military maintains global stability through credible deterrence. Our financial system depends on dollar dominance and stable commodity flows. Iran's crisis threatens all three simultaneously. 2 million barrels per day isn't just a number on a trading screen. It's the mathematical difference between $60 oil and $85 oil. It's the calculation that determines whether inflation stays contained or roars back. It's the variable that decides whether your savings maintain purchasing power or erode quietly while you're not paying attention. You've now seen the setup, the proof, and the calculation. Tehran's bazaar merchants who funded the 1979 revolution have abandoned ship. China's refiners who kept Iranian oil revenue flowing are backing away. Physical precious metals inventories are being drained by buyers who see what's coming. The Supreme Court rules Wednesday on tariffs that could inject massive liquidity or strengthen the dollar. Iran's regime has maybe 2 to 3 weeks before collapse or crackdown. And you have right now to position before markets price in the scenarios we've walked through together. The question isn't whether this crisis will impact your financial life. The question is whether you're paying attention to what the smart money is already doing about it.